Welcome to The Explainer. Today we're diving into something that's literally built into Bitcoin's code, a kind of predictable shockwave called the halving. And believe me, it has huge consequences for the whole crypto world. So what if I told you there's a financial asset out there with a pre-programmed event, something that happens like clockwork every 4 years and has historically come right before massive price surges? Well, that's exactly what the Bitcoin halving is. It's not some random market swing, it's baked right into the system.
Okay, now take a look at this. This is where it gets really interesting. This chart shows the price of Bitcoin 1 year after its first 3 halving events. I mean, just look at these numbers. After the first one, it went from about $10 to over $1,000. The second one, from around $580 to over $2,600. And the third, from almost $7,000 to a whopping $55,000. Now, of course, past performance is never a guarantee, but wow, that's a hard pattern to ignore.
So how does this happen? To really get what's going on in that table, we've got to pop the hood on Bitcoin itself. We need to understand the mechanics of this halving thing. And it all boils down to one simple idea. The code is law.
Okay, so first things first. Bitcoin is different. There's no CEO, no headquarters, no central bank pulling the strings. It's a peer-to-peer network. Think of it like a massive global team project where everyone communicates directly with each other, no boss required. This decentralization is key. No one person or group is in charge.
All right, so if nobody's in charge, who makes sure everything is legit and the system doesn't just fall apart? That's where miners come in. These aren't people with pickaxes. They're running powerful computers all over the world. They compete to solve these incredibly complex math puzzles, and whoever solves it first gets to verify the latest batch of transactions and add it to the public ledger, the blockchain.
And why on earth would they do all that? Simple. They get paid. They get rewarded in 2 ways. First, they collect transaction fees from people sending Bitcoin. But the big prize, the main incentive, is that they get rewarded with brand new Bitcoins created out of thin air, and that's called the block reward.
Okay, and this right here is the absolute key to everything. That block reward, it doesn't stay the same. The whole system was designed from day one to slow down the creation of new Bitcoin, and it does this through the halving event. It's exactly what it sounds like. Every so often, the block reward gets cut right in half.
And this isn't something people vote on. It's not up for debate. It's a rigid, unchangeable schedule built into the code. It just happens automatically, every 210,000 blocks, which works out to be about every 4 years. You can see it right here. It started at a huge 50 Bitcoin per block, and after the 2024 halving, it's all the way down to just over 3.
So this whole mechanism gets us to the core economic principle of Bitcoin. But this predictable squeeze on new supply, well, it also raises a pretty tough question about Bitcoin's future.
So what's the point of all this? In a word, scarcity. It's about creating digital gold. Think about it. Governments can print more money whenever they want. With Bitcoin, you can't. The supply schedule is fixed, it's predictable, and it's slowing down. The idea is to make it a deflationary asset, just like gold, where it gets harder and harder to find more of it over time.
And this table really shows you the long game. Just look at how that reward keeps getting smaller and smaller. By 2036, we're talking over 99% of all the Bitcoin that will ever exist will already be out there. The rewards become just dust. And then, sometime around the year 2140, it stops. The block reward at 0. And that's it. No more new Bitcoin, ever.
And why is that? Because there's a hard cap. The code says there can only ever be 21 million Bitcoin. That's the max. It's a non-negotiable, fundamental rule of the system.
Okay, so this leads to a huge, maybe even a trillion-dollar question. We just said that miners secure the network because they get paid that block reward. So what happens when that reward goes to 0? What's their motivation to keep all those powerful computers running? The hope is that transaction fees will be enough to pay them, but honestly, it's a massive debate whether that's a sustainable plan for securing a global financial network.
And this isn't just people yelling on the internet. It's a serious topic that academics are looking at. This quote really nails the problem. You're trying to secure a multi-billion-dollar network with a payment system, transaction fees, that goes up and down with the market. Can that really guarantee Bitcoin's survival in the long run? That's the question.
So, let's break this down. The way Bitcoin pays for its security is going to completely change. Right now, it's mostly paid for by the block reward, which is predictable and steady. It's like a guaranteed salary. But in the future, it will have to be paid for only by transaction fees, which are totally unpredictable. That's like switching from a salary to a 100% commission job. And when your job is global network security, that kind of volatility is, well, it's a huge challenge. All right, so let's zoom out and look at the bigger picture here. Because what we're really talking about is this fundamental conflict, this tension between Bitcoin's perfect, predictable internal world and the messy, unpredictable real world that has to operate in. See, inside the network, everything is set in stone. The code is the law. The halving will happen like clockwork. But the second you step outside that network, all bets are off. You're in the real world of markets, politics, and regulators, where nothing is certain.
Bitcoin doesn't live in a bubble, right? Its price and its future are shaped by all these outside forces, and one of the biggest is regulation. The code might be predictable, but government rules sure aren't. Take this for example, a proposed US rule to regulate stablecoins. Now that's not Bitcoin, but it shows you that governments are actively building the rulebook for crypto, and Bitcoin will have to live within that rulebook, whatever it ends up being.
So even though that rule isn't aimed at Bitcoin, it's a perfect reminder of how wild and unpredictable the real world is. We know what Bitcoin's code is going to do. The supply will get tighter. The security model has to change. That part is all written down. But its survival, that's not guaranteed by code. It has to navigate changing laws, competing technologies, and fickle markets. So yeah, the code is set for the next 100+ years. But the real question is, can it actually survive the world?